Are on the call. If you want to pop your questions into the Q&A section, as it relates to anything tax related, right? It doesn't have to just be mobile home parks. Tom is not mobile home park specific, although, we tend to lean that way on these calls, obviously, because this is the MHP Pros. So, there's a lot of tax benefits to mobile home parks specifically, massive amounts of depreciation that you can kind of capture via cost seg. Maybe we can start there. And like Thomas, obviously you don't do cost segs yourself, but how are those incorporated into like the mobile home parks or the real estate assets that you've been seeing during this tax season? What do we know about bonus depreciation over the course of the next year? Are there any changes that we've heard maybe whispers of over the course of the last few months? I know you guys did a presentation on the Trump administration a month ago or so, and that was really interesting. There was still a lot of uncertainty around bonus depreciation. So if anything's been illuminated in the meantime, would love to hear about it. And then, like maybe you can talk about timing of cost segs for those of us who are, just entering deals, or maybe we've had a deal for a long time and we did one at the outset, and maybe we're thinking about doing another since we've done additional capex to our parks. Maybe we could just talk about that in general, because I think that's a big topic for a lot of individuals.
Yeah, cost segregation, absolutely. So let me just start with a brief overview of cost segregation studies for everybody who's in here may or may not be familiar. Then I can go into like bonus depreciation and when it makes sense, things like that. I do see a question in there about the cost seg. So when you buy a property, and you're going to hold it for investment purposes, so in other words, you're going to rent it out in some way, shape, or form rather than hold it and flip it, you're going to be eligible to depreciate that property. Most properties depreciated over 27 and a half years in the case of residential property, or 39 and a half years in the case of commercial property. Um, However, there are components within that property, and I'll get to how this ties into mobile home parks too. There are usually going to be components within that property that have a shorter class life. So, for example, if you buy a building, you might have, and I'll get to land improvements too. But like if you buy a property, you're going to have the building usually. You're going to have the land that's associated with the building. And the first thing to understand is that the land is never depreciated. So land's never depreciated. It's usually going to be carved out. And then they're going to have like the structural components of that building. And that's what's depreciated over 27 and a half or 39 years. But then within the building, you're going to have different components. You're going to have like appliances, you're going to have carpeting, you're going to have different fixtures, different types of plumbing systems. You might have pools, sheds, decks, things like that, that are all depreciated over shorter class lives. And that accelerates your depreciation and allows you to have an increased depreciation expense in the initial years. So typically you have 5-year property, which is tangible personal property. That's things like appliances. That's things like the fixtures and what have you. That's depreciated over 5 years. And then you're going to have land improvements. And with mobile home parks, there's a significant amount of land improvements. We've seen mobile home parks where 70 to 80% of the value of that specific purchase was land improvements. So there is a sizable benefit in many cases for mobile home park investors to use cost segregation studies. But land improvements are depreciated over 15 years. All right, so again, shorter than that 27 or 15-year, excuse me, or 39-year property. But that's where we get into bonus depreciation. And bonus depreciation is interesting because it allows you to significantly accelerate depreciation on property that has a class life of 20 years or less. So we're looking at that 5-year property, that tangible personal property, and we're looking at those land improvements. Now, from 2017 to 2022, bonus depreciation was 100%, meaning that you can 100% deduct the cost of that 5 and 15-year property in the first year that you acquire it, and assuming you do the cost segregation study. Because the cost segregation study breaks down these components and gives you a readout of how much of the value of each of these buckets you have in your property. Now, since 2023, it's been phasing down. Right now, as it currently stands in 2025, it's currently 40%. So that means that when you do a cost segregation study on your property, 40% of that property that's allocated to that 5 and 7 and 15-year life can be depreciated in the first year. Now, with an update of what's going on with bonus depreciation, it's largely believed that it's going to be brought back to 100%. That's what the Trump administration, like them or not, that's what they want to bring back. And it seems that Congress is more or less on board with that. and it's likely to happen. Just this weekend, the Senate passed part of the budget resolution, which opens the door to the budget reconciliation process. And through the budget reconciliation process, they're hoping to pass this big tax bill that will make a lot of these, will either extend or make a lot of these Trump tax provisions from his first term permanent or at least extended. 100% bonus depreciation. Trump had said in one of his speeches, I think the State of the Union, that it would be retroactive to the beginning of this year. But I don't see it being retroactive much earlier than that. And I believe it's likely to come back because it's one of the least expensive provisions of this specific bill. So in other words, it's not like one of these big provisions that's going to blow out the budget or anything like that. So right now we don't know for sure when exactly it's going to come back, but they want to have something done by Memorial Day. So we'll have to sit tight and wait and see if they do bring back 100% bonus depreciation. But as it relates to mobile home park investors, this is important because, again, in some cases, a large portion of the value of the property you purchased will be land improvements. And if that's the case, that's 15-year property, and you're going to want to be able to bonus depreciate that as soon as possible under certain circumstances. I'll go through what those are in a second. Similarly, depending on the type of mobile home park you have, if you own the mobile home parks, if they're 5-year property, those are also going to be eligible for bonus depreciation. And they might be 5-year property if they're not permanently affixed to the ground, right? So if you have a mobile home where it's permanently attached and it's structurally attached to the ground, it's hard to move or is not intended to be moved, then that's most likely going to be considered real property. So you're going to be dealing with that 27.5-year property on that mobile home park, on that mobile home. But if it's not permanently affixed to the ground, then it could be considered 5-year. So that's why this is all really important for mobile home park investors, is that a large portion of your property could often be bonus depreciated.
So only 5-year property can be depreciated with bonus depreciation. Is that what you're saying? Sorry, can you give us the distinction about why 5 years is so
Yeah.
important?
Yeah, so it's so property with a class life of less than 20 years could be depreciated. So that would include the 5-year tangible personal property.
Got it.
That would include 15-year property, which is going to be land improvements. And that's just the way the tax code's written. 20 years or less is what qualifies. And oftentimes within mobile home parks, you're going to see land improvements being a good portion of the value, which is eligible for bonus depreciation. And with mobile homes specifically, depending on the type of mobile home, it could be considered real property, which is that 27.5-year property, or 5-year property if it's not permanently attached to the ground. So that
Understood.
there's like a little bit of nuance there, and but that's kind of the difference there of how that works. If that answers your question.
It absolutely does. And then one follow-up question with regards to like when you're doing your cost seg, when does it apply to that park specifically? So if you're doing, let's say you are rushing to get a cost seg done because you're filing by the 15th, does that cost seg apply to the prior year? Or does it only apply to the year in which you do the cost seg? And maybe this is a better question for a cost seg specialist, but maybe you have an opinion there.
Yeah, no, I could definitely answer that for you. So the entire reason why we do cost segregation studies is to accelerate depreciation and usually use first year bonus depreciation. So the first year you place your property in service, which is the year that you start the operations, you start renting it out, or you start making it available for rent. That's when that's usually when the cost segregation study will be applied. Now, having said that, you don't have to do the cost segregation study in the same year to apply. So to give you an example, you could buy a mobile home park in 2024. It could be November 2024. You bought it, you started renting it out, or maybe there's people already renting out the land, what have you. In that case, you place that property in service, and that's when it's going to be first eligible for bonus depreciation in 2024. However, you have until you basically file your tax returns, which is 4/15, or if you extend it for individuals at least, it's going to be 4/15 or October 15th to actually get that cost segregation study done. So in other words, referencing this property from 2024, I can go get a cost segregation study done today. And as long as I'm at this point on extension, I can go ahead and file that for 2024. So that's usually how it works if you're doing it like the correct way. Now there's ways to fix things, but usually what's going to end up happening is you're going to do the cost segregation study. It's going to be applied to the first year that you started the operations of the property.
Understood. And if we closed on a property March 1st, there's no way to retroactively apply that cost seg, the depreciation to your 2024 taxes, for instance, correct?
Correct, correct. Like if you bought it in 2025, started operating it or placed it in service in March 2025, that's it. That's a 2025 property. Now we're looking at the 2025 tax year. 2024 for at least this purpose would be irrelevant.
Great. And I'm not sure if you answered this question in full, but I want to bring Saeed to the stage real quick and have him ask his question if he has any follow-ups or if this one's answered. I don't know, Saeed, what do you think?
Yeah, sorry. Can you guys hear me?
Yeah,
Yep.
absolutely.
Awesome. Sorry, I'm driving. Yeah, that was extremely helpful. And I just wanted to confirm, like, is that you kind of quoted like 70, 80% of the land value that can be allocated to land improvements. Is that even so that sounds like that would even apply to tenant-owned homes? Because obviously I see the cost seg benefit when you have a bunch of park-owned homes. I just wanted to confirm, like, there's still a huge benefit in a tenant-owned home model. And then the follow-up to that would be, is there usually on a cost benefit analysis, like a value of a park where it makes sense to spend a couple thousand on a cost seg study? Like usually only if your park's worth like a million or more. I just didn't know if you kind of had a general rule of thumb for that because I've heard sometimes that can be the case.
Yeah, that's a great question. That's a great question. So, whether there's a tenant-owned home or there's park-owned homes, there could be value in the cost segregation study because with the park-owned homes, it depends on if they're permanently affixed to the ground, you're going to want a readout and it's considered real property. So the homes are considered real property. You're going to want to know how much of the components of each of those, park-owned homes qualify for that 5-year property. So you're going to want that there's benefit there. If the tenants own the home, you're going to want to know the value of the land improvements that are associated with the property. And you're going to want to know the value of the land improvements with the park-owned home too. With the park-owned homes too. You want to know it in both cases. So to answer your question, it can make sense in either case. For specifics, like in terms of finding out the cost benefit, what you would usually do is go speak to a cost segregation specialist, and they're going to tell you, here's our estimated breakdown of the components of your property based on their information they have available and how much it's going to cost to actually do the study. From there, you can kind of do a cost benefit analysis of how much taxes you would save based on that estimate versus the cost. In terms of like bright lines, like I mean, mobile home parks are usually a little bit more expensive on the more expensive side. So you're not usually probably dealing with mobile home parks that are, less than $100,000, at least, just kind of what I would imagine. So I would say that cost benefit would most likely be there with mobile home parks if you're able to qualify as a real estate professional, because then you could take the losses from the mobile home and use to offset your active income, whether
Yeah.
it be from a job or business. So I hope that makes sense. Yeah, I guess what I'm just trying to say with the purchase price of most mobile home parks being, significant, it's most likely going to make sense to do a cost seg study.
Yeah. That's helpful. Thank you.
No
And
problem.
Saeed, I'll just add that I just spoke with Whipfly or Whipfly, and they are fantastic cost seg team. Steven is the name of the representative there that I spoke with, and I can connect you with him. And he actually walked me through the cost benefit analysis. They do that on your behalf, whether it would be worth it to continue with that cost seg, maybe in this year or in the following, et cetera. So I'll connect you with him. He's a great resource. And what he told me personally is that he's not going to have you move forward with a cost seg unless it's going to be worth it for you. They aim for 10 times the return in order to do a cost seg. So they are really honest and a great team. And what their hope is that, because they're educating you and helping you at the outset, that you're going to grow with them. And then when you buy these larger parks, you'll hire them. And so they'll get their fees eventually. And honestly, of all the cost seg teams that I've spoken to, they're the best. So let me send you over their information after the call, and you can connect with them, whether it's about the park you already own or some that you're thinking about closing on.
Yeah. No, thank you. I appreciate that.
Absolutely. Giancarlo, what's up, man? Can you speak, or you want me to ask your question live for you?
I can speak.
Great, go
What
ahead.
up again? So this might be a little bit of a complicated question, or I probably make it complicated, but to give you some color to it, I'm LP on a Mobile home park deal. I had asked the GP because I didn't know how it worked. I'm like, so you did a cost seg? He said yes. I said, how would my CPA know that that happened? I'm like, is it like, does it say it on the K1? So the GP told me yes. Then when I gave the K1 to my CPA, obviously he put the numbers down, but I was like, so you saw that that was a cost seg, right? And he was like, no, how would I know? I just go by the numbers. It doesn't designate it. So that was my question. If you could answer, like, how does the LP know that the GP did it? And then how do we know that it's done to maximum benefit? Meaning, and again, I might have to talk to another course second analyst, but just from where I'm sitting, or when an LP comes on and asks those questions, I'd love to have the correct answer for them as
Yeah.
far as the key ones.
So they weren't wrong when they said that it is reported on the K1. It is, but it's not like directly reported. There's nowhere where it's going to call out and say, "Hey, we did a cost segregation study." What you're going to have in usually box 2, which is the rental income of the K1, you're going to have a significant loss in that first K1, and that's going to be usually as a result of the cost segregation study, and how you'll know that one has been performed. So it's not like, so they weren't wrong when they said that it's reported on the K1, but they weren't like they weren't 100% right, like where it's like, okay, it's directly called out. It's usually not called out. You'll just know by that large loss in that box that, okay, that loss is most likely a result of the cost segregation study. So I think that might answer the first part of your question. Could you repeat the second part of the question
Yeah.
again?
So yes, the first part, and I assumed that. I'm like, well, the CPA should know that it's a large number, but I guess what's large, right? Like depending on the on the deal. But yes, and then the second part of the question is, how can we, and this may not be your lane, but how can we ensure that that's the best number, right? So like whatever the number is, was the core seg done to maximum benefit? And because I guess on that line it's just one number, right? And
Right.
there's many things on the core seg, so I've never seen a core seg, so that's why I'm asking these.
Yeah. I mean, it's going to be usually you're going to be relying on the general partner to make the decision to go with the best cost segregation company that they can go with, or they might just go with the one that they know, like, and trust and have been working with. So it is hard to verify that as a limited partner because you're not in control in that sense. You might be able to request the general partner to send you the cost seg report that was associated with the property. They may or may not do that, I guess, depending on the specific sponsor or your relationship with them. And then if you wanted to find out, you'd have to go to other cost segregation companies and try to get an estimate on that property, which may be challenging to do, just as the nature of being a limited partner. You may not have all the information necessary to go and shop that around. So I guess to give you a very practical answer here is you probably won't know 100%. You're going to have to rely and trust on the sponsors expertise and their ability to pull together the right team to maximize the benefits. And so that's the practical answer. I don't know that there's a right or wrong answer in terms of the highest and best, because certain cost segregation companies do things a little bit differently than others. So it's hard to, even if you went and got estimates from all the cost seg companies, the final results may all be different anyway. So it's very hard to tell, to be honest with you. So you just have to trust that the general partner is making the right decision.
Excellent, excellent. Yeah, and I always like to put on the hat of the LP, even though I'm the LP now. Plans to be the GP, and when they ask those questions, I want to give them that answer, right? Where it's, you have to trust us, and this is what we can do. Because I've sat in on a lot of GPs pitch, and they just tell you we're going to get a course seg, and then it never goes from there. Like they never explain, like you just did. Well, we use this course segregation company. They're really good. We've used them in the past. We try to get maximum stuff. You can see it. They just assume. Well, I guess they assume people are going to not question it, but I'm at the point now I want to know both sides of it. So thank you for that. Very thorough.
Yeah, no problem. One thing that came to mind though, you could, I guess, ask what company are you using, then go find out, reviews of that company online or through other investors that or maybe secret shop them or something along those lines. But that's probably, I'd say, probably the best that you'd be able to do, at least in my opinion.
Thank you.
And then I'll have a follow-up for that. In terms of LPs, there might be some LPs on this call or people considering LP investment in mobile home parks. How much can they take advantage of of depreciation, right? And I guess this is only unless you're, this is my understanding, and please tell me whether I'm correct. Uh, your depreciable benefit only offsets what income you earn from that property unless you're a real estate professional. Is that correct?
Yes, it's largely correct. So basically what happens is all rental activities, including most mobile home parks, are going to be passive by default under the tax code, which means they can only, the loss is going to be considered passive. It can only offset other passive income or gains on the sale of passive activities. Now, it's not limited to that specific property. So you could have property A, for example, just going to throw out a number, generate $100,000 loss, right? And then you could have property B have a $50,000 gain or perhaps $50,000 of income. That loss in property A can offset property B. And if in any specific year, your passive losses are in excess of your passive income, which is quite common, it's going to be suspended and carried forward to future years where it can be used. So oftentimes, like if you're not a real estate professional, cost segregations, their net benefit to you may differ, right? But the benefit, the way you'd play that game as a passive investor is you'd want to look at how much passive income are you generating in any given year? Do you have enough passive losses to offset that passive income? If yes, then you're in good shape. Or are you selling a property that's perhaps going to generate a passive gain? Okay, if that happens, it's called the lazy 1031 exchange. You might want to go look at do I need additional passive losses to offset that gain? So that's how you can use it. Whether or not it makes sense to do the cost seg is going to depend on the facts and circumstances and what the levels of income are and potential gains in that year. But if you are a real estate professional, it's a little bit different. Real estate professional, those losses will be considered non-passive. And what that means is that it can offset other income that you might have, such as income from your job or your another business that you might be running, or perhaps you have portfolio income, which, believe it or not, is not considered passive. So portfolio incomes like dividends, capital gains from the sale of stocks, bonds, and like securities, those are explicitly carved out as non-passive, believe it or not. So if you have that type of income and you qualify as a real estate professional, you can use the loss to offset that active income. And in many cases, if you are a real estate professional, you do have higher amounts of active income, so to speak, then a cost seg could very well make sense for you. So,
Yeah, and then a follow-up to that, in terms like putting ourselves in the shoes of a GP at this point, how do we best market to potential LPs this depreciable benefit? Given most of these LPs will be passive investors likely, and they will not be real estate professionals. Like, what would you say to us to say to them in order to kind of give them comfort that this appreciation is something they can use? And I guess you've sort of answered it already, but like, let's think from the lens of marketing for a second.
yeah, absolutely. So I'm in the same bucket. I have a few LP investments myself. So at the end of the day, the earned income you generate from a job or a business is taxed at federal tax rates up to 37%. You're also going to be subject to state taxes, FICA, and Medicare taxes, right? If you're a high income earner, you're making several hundreds of thousands of dollars a year. It's not uncommon to see people paying 40% or more of their money in taxes, right? And it's a necessary form of income in many cases, but it's not the most efficient. Whereas you have rental income, right? Rental income is also taxed at 37%. However, rental income can be sheltered through depreciation. So as you make these investments as an LP, and as your income and your passive income and your passive gain from the sale of these interest in limited partnerships when the property is ultimately sold, as that level of income increases and you're able to decrease, as that increases and you're able to shelter that with depreciation, that is the benefit. Because, for example, if you had $50,000, let's just say you had a W-2 job, right? And you're in the highest tax bracket there is, 37%. We're just going to keep it at the federal level. We're going to ignore state taxes for now. So let's just say that you had $50,000 in income from your W-2 job. You got a nice bonus that year. Well, guess what? You're at the 37% tax bracket. You just paid $18,500, right? Dollars in taxes on that. But let's just say that you made a bunch of investments and you had $50,000 of cash flow, right? That was generated from these investments, but it was sheltered thanks to depreciation. Well, guess what? Now you paid $0 in taxes on that source. So if you want to look at it that way, for high income earners, typically the people who are investing in limited partnership interests, the money they're generating from their active trader business or their job is highly taxed, whereas this is very tax sheltered. So that's the benefit of all of this. And it's often overlooked because so many people find out about, oh, I can use these losses to offset my W-2 income. And when they find out maybe they can't, it's like, oh, they're deflated. It's like, no, you're sheltering your rental income and gains from the sale of those properties from tax, which is significant, because this is what it does. It helps you reduce your effective tax rate. Your effective tax rate is the amount of tax that you're paying divided by the amount of income that you're generating. So as your income, including the gains and all that stuff, is increasing, but your taxes are staying the same because all of this is sheltered, because the rental portion is sheltered, you're reducing your effective tax rate, which is effectively reducing the amount of taxes that you're paying overall. So I hope that made sense. That's the huge benefit of investing in real estate, whether you're an LP or not, but that's how LPs take advantage of this strategy.
It absolutely makes sense. And if I'm thinking in terms of a GP selling to an LP, the benefit kind of extends the more LP investments you have and the more passive income you start to generate from rental properties. So that's inclusive of rental income, and then the sales on the gains from sales that you make on those LP investments as well. So yeah, that makes a lot of sense. And I think that's going to be extremely helpful for those of us syndicating deals who need to communicate that to LPs as well. Saeed, I know you had a follow-up question. Why don't you just go ahead and ask it? And if we did cover it, we'll cover it again quickly. And otherwise, you can rewatch. Go ahead.
Yeah, no, and sorry I had to step out. And I actually have a follow-up question to what y'all were just talking about after this one, if that's okay. But for this one, I was just asking, so I get the whole passive income, active income, but let's say like I built up a ton of passive losses over the year due to real estate, right? And the past 2-3 years, and now I decided to go active this year, like classify that way, and I still have some active income. Since I've had all those passive losses built up, right, in the past years, do those all now flow through and can offset my active income for the year since they're kind of just sitting back there and haven't been utilized?
That's a great question. And the short answer to that question is they don't get unlocked. So what happens is say you qualify as a real estate professional. I think that's what you're referring to here. Like when you go active, the losses in the year that you qualify as a real estate professional will be non-passive. And then every year going forward that you qualify, the losses generated in those years will continue to be non-passive as long as you continue to qualify. The ones you had from before you qualified, they're still considered passive. But if you have income from those specific properties that from your properties that generate those losses, they will be able to offset that. So unfortunately, what I'm trying to say here is the prior passive losses you have remain passive, and they're not going to be unlocked when you become a real estate professional, unfortunately.
Oh, okay. No, that's good to know. And my second follow-up question was, sometimes I work with investors who are doing 1031 exchanges. Are they able to 1031 their stuff into like a deal if they're an LP?
Yeah. So as a limited partner, so let me start here. So 1031 exchanges have been limited to the real property. So you can only exchange real property for real property. As a limited partner, when you're investing in syndications, you're investing. You have a partnership interest. You have an interest in a partnership, and the partnership owns the real property. So as the LP, you can't 1031 exchange. What you can do is say the general partner says, you know what, guys, we're going to go ahead. We're going to 1031 exchange, 123 Main Street, right, into 1234 Main Street, whatever. We're going to bring you guys all along with us. If you want, you can go ahead and the partnership can 1031 exchange, and all the LPs can participate in that. But as an LP, you're not going to typically be able to 1031 exchange it in that structure. Now, there are ways you could do it. The general partner could opt to drop out the property into tenants in common, where all the LPs now own a slice of the real property. It is possible to do that. I will say that it's very costly to do that, and oftentimes unless you're dealing with sizable investors, it's most likely not going to be a viable option. I don't have a specific threshold, but like most typical syndications, it would probably not make sense to do that, I would say.
Okay, that's helpful. Thank you.
Problem.
I'm not seeing Eric raise his hand. Let's bring him to the stage real quick. Hey, Eric, go ahead.
Hey guys, hey Tom, thanks for doing this. You guys actually answered a bunch of my questions about, raising your first, raising for your first deal and kind of explaining to LPs who like might be a first time LP why this is a good idea. And I kind of gathered that like even if they're a high income earner, it's not really going to be a tax benefit to what they're earning from their W-2 because they're not real estate professionals, and LPs positions will always be passive. But as you accumulate more passive gains and losses, you're saying that's like shelterable income with losses from other properties or even that property. Did I understand that correctly?
Correct. Like, right. So like, yeah, unfortunately, they won't be able to offset their W-2 income directly with that, but it's the rental income, which is taxed at 37%, the gains that are taxed, up to 20%, and then the recapture from that, which could be taxed up to 37% as well, can all be sheltered with passive losses. And that's very difficult to do. Like to add on to this, right? The other way to look at this is this: like if they're looking at, okay, I could put $50,000, for example, into the stock market today, or I can invest as an LP. Not only are they sheltering it from tax, which is beneficial, but it's hard to shelter the gains from the sale of stocks in a taxable brokerage account from tax. You're going to end up paying 15 to 20% on any capital gains from the sales of those stocks in most cases, unless you're in the 0% tax bracket, which is probably not the case for most investors. And then the dividends, you're also going to be paying ordinary income rates. If they're qualified dividends, maybe you're paying 15 to 20%, which is the capital gains rates. The point is, those investments are difficult to shelter, but with real estate, that's easy to shelter. So even if they're looking at the alternative investments that they can make, like their options, like real estate still is very tax sheltered. So it's another selling point. If that helps.
Yeah, and then so what does happen when you sell a property and you've got LPs? There's a big gain there. They can take that money and then put it into another investment, cost segregate, and then get a huge loss in that same year to offset the gains from the sale of the previous property. Does that work?
Yeah, they call that the lazy 1031, but that's exactly how it works. Like say 2025, the LP investment sold or the underlying property is sold, they have a big gain. The first thing they're going to want to do is go back, look at their prior year tax returns to see if they have any passive losses that were suspended and going to be carried forward. Those can help offset that gain. If they don't have enough or they don't have any, they can also just take the money, invest it in that same year. So in 2025, buy another LP investment. As long as the sponsor is doing a cost segregation study, there's likely going to be that sizable loss that will be able to offset the gain. So that would be the play there.
And could they take that LP gain and buy their own property, since it would still be a long-term, say it's a long-term rental and it's still a passive rental? Would that work? Doing it?
Yes. Yeah, that would work too.
Can't do a 1031, but they can buy a new property and do a cost seg and offset losses that way.
Right. Exactly. They could do
Okay.
that. Would work.
And then what about, just skipping the cost seg, if you're buying a property and you can just like ballpark it, instead of doing, hiring the engineer to do it, just say, okay, well, we're going to just guess that it's this. Maybe you have a smart accountant like you guys. Do you guys ever do that? Like, okay, well, we're not going to pay for a cost seg, but we can ballpark that, this part of this property is worth this. And on average, this is what we see. So we're going to just say, okay, 60% or 40% this year equals this. And let's just claim that. Do you guys, what are your thoughts on that?
Yeah. So we would not. So there's a few things here. So we might eventually start offering cost segregation studies right through our firm, but that's separate from this. Like we wouldn't do that. So there's the IRS has the audit techniques guide, like for cost segregations, and it's all these rules that have to be followed for cost segregation studies. So we typically wouldn't guesstimate what it is. There are certain situations where, say, there was a ground up development and that specific client had all the the invoices, receipts, the scope of work for that, where that could be broken down into the 5, 7, 15, and 27.5 for 39-year property. That's something we may take a look at and say, okay, great. We don't have to do a cost segregation study because we effectively have one from having all this information, but we wouldn't guesstimate. Under audit, it just wouldn't hold up. To give you some context, we've had some audits that came up recently with cost segregation studies. And what they're going to do, the IRS is going to try to attack your qualification on your ability to do the cost segregation study. So guess the and estimate, and also the method in which the cost segregation study was performed. So guessing that would probably could result in issues if you were ever to be audited, for sure. So we wouldn't personally, we wouldn't guesstimate it. We wouldn't do that.
And even in the case of, like, say you got a heavy park owned home community, and you say, okay, well, we're going to say the land is worth 100,000. The park itself is worth, whatever improvements are worth 300,000. And this is that these allocations are made in the contract and everybody agrees to them, and the park owned homes are worth 200,000. And you wouldn't accelerate at least that 200,000?
Yeah, we've seen that type of stuff before, like purchase allocation, where they're saying, okay, you're buying this amount, it's going to be allocated to 5 year, this amount's going to be allocated to like 15 years, this amount's going to be allocated to the 27.5 year, and like this is how it's purchased out. I don't know, that's very defensible, because like at the end of the day, they're going to ask like, okay, how did you come up with those numbers, right? Like, who is qualified to make the determination of how much that valuation was? There needs to be some type of supporting like substantiation for that. So it's not something we would typically do. I know what you're talking about, but I would recommend almost always, if you're going to try to do a cost seg study, if you're going to try to do that, do a cost segregation study, because that's going to be defensible.
Got it. Thank you very much. Appreciate it.
No problem.
Anybody else have any specific questions right now? If not, I can ask some questions that I have on my mind, specific to if you own a park on your own and you also own a management company, is it beneficial from a tax standpoint to be charging yourself in one entity those management fees? Or are you kind of getting double taxed at that point because the income from your management company is taxed differently and less advantageously than the income from your property?
Yeah, so you can do that. Whether or not it makes sense to do that, it depends on what your objective of doing that is. Some people want to just have like really good asset protection, and their attorneys will say by separating all these things out into different companies and having asset management, having a property management, another manager there basically can strengthen your asset protection. That's one reason why it's done. But some people do it also because they want to try to generate some self-employment income. Because all right, so when you start paying yourself property management fees, this is going to be considered active income. So you're basically, your rental properties or your mobile home parks are basically paying it. It's an expense, right? It's going to this other management company. This management company is going to have to pay self-employment taxes on that. And sometimes it's beneficial to do that if you're trying to get access to a 401k, or you're trying to put some type of money into Social Security. I've seen some people do that before. So I guess to answer your question is, you can do it. It just depends on why you're doing it, whether or not it makes sense to actually do that. Most of the time it's going to be for legal asset protection purposes, which at that point, you're probably not looking too hard at the tax impact of that. I mean, you want to know what it is, but oftentimes, the asset protection might be worth paying the few extra dollars that you're going to end up paying in taxes, if what I'm saying there makes sense.
It absolutely does. And it sounds like it would not be beneficial from a tax standpoint, but it could be from an asset protection standpoint.
Right.
Just because it's a active income versus passive income through the property itself. Is that correct? Am I sort of saying that correct?
Yeah. You're basically taking what could just be considered, if you just manage the property without a management company, it would just be, everything would be passive. You don't have to worry about it. But now what you're doing is you're just taking passive income basically and converting it into active income and getting charged a self-employment tax. And unless it's for, asset protection primarily, there's no real reason to do that.
Sure. And I'm sure Eric has something to say about that, because I'm not sure he's doing a raise for this current one. So it would make sense, I believe, if you were going to raise from LPs, because you want to cash in on the management fee income from those LPs. And so, yes, it becomes active income, but you're owed that from doing the management. So that 5 to 10%, whatever it is. Is that correct?
Yeah. Usually when if it's just like, to your point, just your own property, it may not make sense. But if you're doing it where you're raising money, it's a little bit of a different dynamic. There's there's different structures, more asset protection you have to worry about. And yes, you do want to get that management fee from your LPs. Usually it's that asset management fee, and that's usually paid to a management company. So that's a little bit different, because like when you're looking at syndication, you're really running a business within a business. It's like, okay, there's the real estate level business, right? Like the actual property level business, but then there's also the syndication business, which is kind of on top of that. So you have two levels of clients. You have investors and then you have tenants, right? So in that case, like that structure is very, very common, where you have a management entity, you have the property entity, and that's very common in that specific scenario of syndication.
Absolutely. I'm going to let Eric ask one question and then I'll hand it off to Tiernan. Go ahead, Eric.
Yes, just on that topic, that's really helpful. If you're paying, say you've got a property management company, you're paying from an LLC that the property's in to the management company, but you're only paying as much as you're paying your park manager, right? Like your park manager is getting $10,000 a year. The park pays the management company $10,000 a year, and then that management company pays your park manager $10,000 a year. Then from a tax perspective, that doesn't really make a difference. But doesn't it help from a liability perspective that now your manager works for an LLC that doesn't own any assets? So if your management company gets sued for doing something stupid, then your property's not at risk?
Yeah, so from a tax perspective, what you're saying, they would net out, right? You have the LLC receiving the fees, and you have the LLC paying out the fees. You'd have net income zero on that. I'm not an attorney. I can't speak for asset protection purposes, but that's how it usually works from what the attorneys that I've spoken to. So to answer your question, yeah, that's it's for the asset protection, and if structured properly, it should operate like that.
Yeah. Yeah, and that makes sense, right? Because so if you're not paying yourself out of your I get it with the syndication. What Michael was saying makes total sense, and what you're saying about the syndication. But you're only owning a property, and you want to protect your property from any dumb things your manager is doing, and you're not paying yourself out of the management company. You can just pay your manager, so it nets out, right?
Right. Exactly.
All right, great, thanks.
No problem.
All right, Tiernan, go ahead. What's up?
Hey, Thomas. Super basic tax question. When we're documenting all of our expenses for a mobile home park, or like for my home sales business, buying and selling homes, all of our rehab costs, fuel, let's say like home office costs, computers or what have you, office materials, all of our general business costs that we're tracking, we're keeping it on a spreadsheet or QuickBooks or whatever accounting software. That when we file taxes would not be sent to the IRS, right? So it's basically for our own personal good to stay on top of our expenses and keep everything tracked. But we're not actually sending that with our tax return, but it would be good to have in case of a future audit to show all of those expenses, showing all the receipts and everything. But if we're not audited, we wouldn't need that, right? They wouldn't be seeing that.
Right. So what you're referring to is you're saying like you have the mobile home park, right? So the mobile home park, where you're gonna, depending on whether it's in your personal name or in like a partnership, there's gonna be a Schedule E or gonna be an 8829. That's basically the partnership version of Schedule E. That's going to have the property's income and expenses just listed out within that format. You're not sending over the receipts or anything like that. But to your point, having all of that is good to have in the event of an audit. Because say, for example, this is going to assume it's Schedule E, for example, they say, okay, this line item is way too high, or it's out of whack with their general ratios that they have in their system. They might audit you, or they might send you a notice saying we want more information on why, repairs, for example, is $39,000. And at that point, you're going to want to be able to pull up the receipts for that information. So to answer your question, you don't typically send that stuff to the IRS, but it's supporting documentation for the information that is ultimately sent to the IRS. So there's more or less a profit and loss statement, if that answers your question.
Yeah, definitely. And when you are audited, let's say you're claiming expenses for a rehab was 20,000, and then you only prove 10. That difference there, that's just something. Basically, if you pay that money that you owe in taxes that they deem you owe, everything's fine, right? You're not like criminally prosecuted or anything, correct?
Yeah, if you pay the taxes that you owe, or you're saying if you lost the audit and there's a discrepancy, right? And like you had to pay money back. Just to clarify, that's what you meant.
Yeah, like if there's like an expense that they thought was too high, they audit you, and then you're unable to prove
Right.
that the entire amount.
Yeah.
I guess,
Yeah.
then you're fine.
Yeah, you're not usually going to jail over that. It takes a long time before you go to jail with the IRS, but that would just be, you would just have penalties, back taxes, penalties, and interest that you'd have to pay. That's the penalty, is the actual penalties for underpayment when you should have paid more than you did, and then the interest that they charge you. I mean, that's really that's the penalty usually. Usually when you go to jail, it's usually fraud, many years of doing crazy stuff like not reporting your taxes for like 10 years. Evading the IRS and doing things that are flat out fraudulent, which this stuff is rarely, I think, gets to that level. So,
Yeah, that makes sense. I guess my question would be: is something as simple as overinflating a rehab budget, is that considered fraud, or that's considered more just a minor mistake?
Depends on intent there, Tiernan.
yeah. I mean, yeah, there's a lot of things like if you were just fraudulently reporting numbers on your tax return, you had no substantiation, but just came very clear, you might be facing some issues, right? But if they just said, hey, we don't believe that, we don't believe that all of this should be considered repairs. Some of this should actually be considered capital improvements, or like, you're like, this doesn't qualify as an expense. That's usually not going to result in like that fatal of an incident. But if you're just like making stuff up and reported like 50 grand of phantom expenses that just flat out don't exist, right? That's the point where you're getting into territory that might be criminal, and yeah.
No, that's a good answer. Thanks, Tom. And then I wanted to follow up with this because I think this is on the heels of Tiernan's question. What are the things that are most like that trigger audits the most for those who are listening now or later? What are things that we should definitely be documenting religiously or reporting correctly as best we can?
Yeah. So biggest things that are going to trigger an audit, audit rates have increased a little bit over the last few years, and we've seen that kind of trickle in, is going to be the real estate professional status. If you're using the real estate professional status, you need to make sure you're documenting your time. So the time it's to qualify 750 hours and more than half your total working time. So you're going to need to make sure that you clearly prove that you spent 750 hours. It's a time log. If you have a lot of real estate, perhaps it's a calendar system, but you're going to need to be able to prove that. That's something you're definitely going to want to make sure you're documenting. That's the real estate professional status. With cost segregation studies, that's also been challenged. You're going to want to make sure that you have the evidence from the cost segregation study of that actual study and that they're available to support you. Sometimes cost segregation study companies just disappear during an audit, right? You can't find them, and there's no way to back up how they got to their answers, because usually they're not giving you with the cost seg report, they're giving you the breakdown, they're giving you some supporting information, but they're not giving you that granular information that you would need to defend yourself in an audit. So you'd want to make sure that if you're using cost segregation studies, that you not only have the report, but you also have a line of access, ideally, with audit support in some way, shape, or form to that cost segregation company, because that could be an issue. Also, like repairs and maintenance expenses are also another audit trigger. A lot of times what ends up happening is repairs and maintenance are sometimes misclassified, capital improvements that should be depreciated over a period of time are sometimes miscategorized into repairs or maintenance expenses, which inflates it on Schedule E. And that could trigger an audit too, and they may recategorize it. Again, you're probably not going to go to jail for that, but those are common things that we see. I'm trying to think if there's anything else that we see that's really big. No, really, real estate professional status, short-term rentals. I know it's not the topic here, but we see that too. And cost segregations and repairs and maintenance. Those are kind of big audit triggers for the most part.
Awesome. Thanks, Tom. And we're running up on time here. 5 minutes left. I want to make sure we give you some time to tell everybody who's listening how they can reach out to you, when they should reach out to you, because I think that's an important point, right? It's not just when you own a property, but potentially if you're starting to think about it or you're under contract, et cetera. So why don't you talk to that and let people know how they can reach out to you and when they should start with you?
Yeah, absolutely. So there should be a link within the school community if you do ultimately want to reach out, that you can use to schedule a call with us, and we'll evaluate your situation. But long story short, when you start kind of getting to real estate and you start getting to assets like mobile home parks that are typically a little bit more expensive than your typical single family home, you're going to want to speak to a CPA, definitely before tax time for sure. Usually after the year ends, there's very little things that could actually be done to impact your tax situation. So you want to get in front of that and be proactive, right? So if you already own property and you've not already discussed, tax planning with the CPA, now might be a good time to get started, because we're still only in the beginning inning of the year. Still, maybe it's middle of April. You could still make a lot of moves this year. But if you're getting a property under contract, and it's looking very, very serious that you're going to actually acquire that property, that can also be a great time to start engaging a CPA so you could hit the ground running, start executing the tax strategy right then and there. So to answer the question succinctly, you generally want to start talking to a CPA before tax season, right? So the earlier within the year, the better, but like it's better late than never type of thing. So I'd say now is a great time to get started with a conversation for 2025 tax planning, right? If you've already owned a portfolio or you're very close to acquiring one. So if that makes sense. For tax preparation, that kind of goes hand in hand. So if you're already working with the tax professional on strategy, they'll usually be able to do your tax returns as well. So that's conversation's already kind of started. But if you have not already talked to somebody about your 2024 tax returns, you got to get that conversation started right now. So like last year's tax returns, now is the time to do that if you haven't already, because as we kind of get longer in the tooth, a lot of CPA firms, including us, are not going to be able to take on additional 2024 tax returns as we get into June, July of the year, because we're going to be at full capacity. So if you're not already got your 2024 returns with somebody, you got to go do that now. Like that's urgent, more urgent. But the tax planning, sooner rather than later.
Yeah, and I guess for those of us who are behind the eight ball, luckily not me this year, but those of us who are, is there anything we can do? There's like 5 days left to filing. Like, what would be our options at this point?
Yeah, you're going to want to extend your tax return. That's the first thing you want to do. So for individuals, you have until October 15th to file your taxes as long as you're on extension. And you have to file the extension by 4/15. So by next Tuesday. For partnerships and S corporations, so partnerships probably more relevant here. That time to extend your returns already passed. That would have been 3/15. But you have until 9/15 or September 15th rather to schedule to file. So if you've not already filed an extension for your personal tax returns, do that sooner rather than later. You want to do that before Tuesday, on or before Tuesday. And you're also going to want to make any estimated payments. If you do have any tax bills due, or you do understand, or you do know what your estimated tax is, you want to make that by 4/15 as well for 2024 to minimize any potential interest or penalties that may accrue. So that's what you want to do now if you've not already filed, if you've not already extended your personal return.
Great, thank you. Tiernan does have one last question. You have time to answer it?
I do. I have a few more minutes.
All right, go ahead, Tiernan.
Okay. Yeah. Not to ask like another really basic question, but how do I file an extension? I'm guessing it's just a simple form.
Yeah, so you can, I believe, if I'm not mistaken, you can file an extension directly with the IRS. I think you could just do that. If I'm not mistaken, I've not done that in a while. But if not, you can also do it with like TurboTax or H&R Block. Like a lot of these companies allow you to file free extension. So it's just filing a form with them, and you'll be able to extend it. So try and take a look right now if you could do it right through the IRS.
And is that for the IRS and state as well? It's the same form, or are they filed separately?
So a lot of states will automatically accept the federal extension, but there's certain states that won't. So I would just recommend Googling your specific state and seeing if they accept it. Do you know what state you're in by any chance?
New York State.
New York State, except I'm pretty sure that they do federal extensions because I've lived in New York for a while. Okay, does not. Okay, does not. You have to file a separate extension. It's Form IT 370 with New York State. So you have to file a separate one in the case of New York. I've had a CPA do my own tax returns. Don't tell anybody for the last few years. I filed in a lot of different states, and I just don't have state expertise in every single state. So like I just have them do it. But yeah, you do need to file a separate one for New York. And TurboTax can also help with that too.
Great. Thank you, Thomas. And I just wanted to say on behalf of everyone at the MHP Pros, everyone listening, thank you so much for your time tonight. I know it's a busy time for you and your firm, so we very much appreciate it. We will hear from you, I think, next month or the following. And, good luck, everybody, this tax season. Give Tom a call for next tax season if you are investing in real estate. He and his team are fantastic, and they've helped a lot of our current members/mentees already. So, looking forward to seeing you next time, Tom. Thanks again for all this great